All right, hi everyone. Today I'm joined by Tom from the Investing with Tom YouTube channel. Tom is based out of New Zealand and is growing one of the best YouTube channels in the finance world. I think what I like most about Tom is he doesn't make his videos for YouTube clickbait, title-y kind of stuff. There's no buy Tesla recommendations. There's no Bitcoin conversations, which is great. Just down to earth, common sense, interesting information. So full respect to Tom for being himself. So please go and watch some of his stuff. I think if you like my content, you will really like Tom's stuff as well. Today, I hope that you will enjoy hearing from Tom and get into the mind of a real value investor. Whether you are just starting your investing journey or have been investing for a long time, I'm sure you'll get a lot out of this. So we'll get to see why Tom has his outrageous mustache as well. And we'll hear about what's going on there. And all right, so Tom, I guess just briefly, very briefly, just tell us what you're currently doing and how what you're currently doing in your day to day is helping you with your investing.
Yeah, cheers. And thank you for having me on. So, yeah, I guess I'm just sort of like a normal everyday Kiwi person. I've had a couple of conversations with sort of sponsors that want to work for the YouTube channel recently, and they keep calling me an influencer, and it feels very strange. So I'm just a regular guy that kind of found this interest in investing, probably 3 or 4 years ago at this point, maybe close to 4 years ago now. Sort of came out of university, started earning some money, was trying to sort of figure out what I do with it, and sort of discovered this whole world of stock market investing. And yeah, sort of started up the YouTube channel, and it's just kind of been going since then. And it's been a really cool journey. Met lots of people. We wouldn't be having this conversation if I'd never uploaded a video to YouTube. And I always say on these types of things, it's incredible, like how much you can learn from trying to explain an idea to a camera. It's really, it's easy to think you understand something, but when you try to sort of explain it to a camera and all that kind of stuff, you know whether you understand something or not. So yeah, that's a bit about myself. Been running the YouTube channel a couple of years now. Try to put out 2 to 3 videos a week on all things investing, probably fairly sort of heavily leaning towards like Buffett style value investing. But yeah, that's what I do.
Yeah, great. I fully agree. So I've only been YouTubing now for 6 or 7 months, and the amount that I've learned in the 6 or 7 months is more about investing is more than I learned in the previous probably 5 years. So
Yeah.
I agree. The best way to learn is to teach. So yeah, fully on board with that philosophy completely. Okay, so you're doing some Buffett style videos at the moment. You said you're a bit more heavy onto that. Why that style, and how did that sort of develop, this sort of value investing Buffett style approach?
Yeah, it was, to be honest, it's something I found fairly early on. Like I was just kind of digging into the stock market, and I made my first couple of investments, and it was, they actually worked out okay, funnily enough. Like I just purely got lucky, but it was literally just looking at a chart, like Google XYZ stock, oh, it's going up, and kind of put some money into that business. And I fairly quickly learned that, for me to get comfortable putting like real amounts of money in at some point, I'm going to need to better understand what I'm trying to do here. And then sort of stumbled into the world of Warren Buffett. And the whole philosophy just sort of made sense to me, looking at companies as businesses, trying to understand what they're worth. I guess here in New Zealand, we have a very strong sort of real estate investing community. A lot of everyday Kiwis are sort of invested in real estate. And a big chunk of, a big driver of making that work really well is paying an appropriate price for a rental property, for example. So applying a similar sort of logic to buying businesses in the stock market just really clicked with me pretty early on. And then once you discover that, you're down the Buffett rabbit hole with, reading the investor letters and trying to understand how he built sort of what he's gotten to today. So yeah, just something that really clicked. Like I know a lot of people invest in businesses that they like and all that kind of stuff, and that's perfectly fine. But for me to get comfortable putting real amounts of money into the stock market and using that as a vehicle to grow wealth over time, I think thinking about companies as businesses is something that just made a whole lot more sense to me.
Since you've been studying Buffett quite a lot, because in his early days, my understanding was that, so the first 10, 15 years, he was going into like a lot smaller micro cappy kind of size companies and looking for 50% ROI, looking for severe discounts to its book value, things like that. Is that So are you trying to mimic that kind of idea from his early years, or more of his later years where he's looking for the return on invested capital and that sort of compounding over long periods of time?
Yeah, look, I'm open to both, and I'm probably more open to the older school Buffett than I think a lot of people are that follow him and have seen what he's done in the last 20 or 30 years kind of thing. I think, I mean, fundamentally, what Buffett's trying to do at all times, regardless of whether he's buying a high quality business he wants to own forever, or whether he's buying, when he was first getting started in the 50s and 60s and buying these small, non-profitable companies that, had a whole bunch of assets and you could buy them really
Asset
cheaply.
plays, yeah.
Yeah, and in either one of those scenarios, um, he's trying to invest a certain amount of money into a business, say, $100, for example, and he's trying to get far more value than $100 in terms of what he's acquiring and with ownership in the company. So I think if you're someone that wants to invest in, the modern Buffett style businesses, you're probably going to get pushed towards the larger, really closely followed companies, the Apples, the Facebooks, the Googles of the world. And the likelihood that you're going to find those companies really heavily mispriced is not that high. You're probably only ever going to see that in, big market crashes where there's not necessarily something going wrong with that business, but just the whole market is crumbling for whatever reason. So I think if you do focus on those smaller companies, there's a higher probability of you finding those mispricings, which is why I find it quite interesting. The downside is obviously that you have to keep finding these things. So if you find lower quality businesses, you buy it at half of what it's worth, it goes up to 90 or 100 cents on the dollar and you sell it. Now you're just sitting with cash and you have to find something else. Whereas if you're, Buffett, Charlie Munger style, Charlie Munger bought Costco in the 1990s and he's owned it ever since, and it's just kept going up and it's been fantastic. He's just sat on his backside and enjoyed it. So, there's pros and cons to both, and I'm open to sort of both schools of thought on that.
Oh, that's awesome. I think everyone would love to hear that, because I get that question quite a lot with which sort of style to go, and why asset plays, why these growth plays, and I think it's good to be open to just good value. So
yeah, for sure.
All right. Your long-term goals, what are they? Not just for the YouTube channel, but you individually as an investor.
Mm-hmm. Yeah, well, I guess with YouTube, it's been a great journey so far, and I'm kind of just going to continue chipping away at that and sort of see how it goes. I guess thinking back fundamentally to why I was trying to put money to work in the first place is to grow my wealth, and not because I have some sort of number in mind that I'm really ego driven to sort of get towards or anything. It's really about just having options, and wanting to do more things that I enjoy, go fishing or go to the beach or whatever it is. So look, I'm trying to chase that kind of stuff down fairly aggressively. Like, I'm 4 or 5 years out of university now. I still live like an absolute student and save like a machine, and invest as much as possible and all this kind of stuff. So look, longer term, that's sort of where I want to get to, is just have options. Even if I do want to keep working and pursuing things, just have the ability to not do it because I have to. And in terms of the YouTube channel, like I say, it's been an incredible journey. So I just want to keep growing that as well. It's a pretty nice sort of side income source for me at the moment. So if that continues forward, that's great. If not, I'll continue learning lots and sort of pumping the videos out as well.
Oh, it'll keep growing for sure. You'll be a full-time YouTuber before you know it. I'm very, very confident that's where it's going for you.
We shall see.
Fully agree that money doesn't buy you happiness, but options and flexibility do, and money gives you options and flexibility. So in a roundabout way, money will help make you more happy. So now you might be wondering, what is the deal with that thing on Tom's face? So I think there's a bit of a reason for his madness. Tom, do you want to talk about why you're growing a moustache at the moment?
Yeah, I usually rock the beard, so it feels a bit weird to only have this part growing. So, basically, I actually had this idea originally at the worst possible timing. I had it in probably December last year. So, I had this idea for one of the investors. So I'll step back a little bit. One of the investors that I follow really closely is a guy by the name of Moustache. Many people may already know him.
He's on my channel quite a lot. Yeah.
Awesome. Yeah. So, Cabrai's a, Buffett disciple and all that sort of thing. He's had great returns over a long period of time. I've learned a lot from him. And one of the attributes he also has is a fantastic moustache. So I thought, what better way to celebrate the lessons I've learned from Moustache Cabrai than to do a series called Movember on the YouTube channel. And one of the other things I've done, is basically tied into basically a fundraiser for the Movember Foundation. So I'm raising money for suicide awareness, mental health. And yeah, it's been fun. I'm glad I can actually grow a Mo over a few weeks. I was a bit nervous that I might not have enough to show, but it's getting there. I think it's got about 5 days to live.
Yeah, well done. That's been
before it comes off.
a little over 3 weeks. That's pretty good. Pretty impressive.
Yeah,
That's
not bad.
at all.
Yeah.
No, very good. That's a really worthwhile idea. I think that's great that you're doing it on your YouTube channel to raise some money. I think that's really good of you. I'm going to kick in $50 plus whatever the ad revenue makes for this video as well. So yeah, I'm fully on board with your cause, and I'm glad. It's good to see people out there doing stuff like this. So cool.
Yeah, appreciate it.
Happy to support. All right, let's get into a few more interesting questions. So more specifically about some of your investments you've made. What has been your worst investment?
Yeah, sure. I guess I mean, the most truthful answer to that is probably my worst investment still to come, I reckon. I think it's kind of just a part of investing that mistakes happen over time. One of the lessons I have learned from Monish Prabhai is that he says that, even the best investment analysts are wrong at least 1/3 of the time. And even if you do have that sort of track record, we're looking for businesses that produce really outsized returns. So, if your winners outweigh your losers, you'll probably have a reasonable track record over time. So, I guess to get into more specifics, probably there's only actually one company I've ever locked in a permanent loss of capital on. In other words, the only one company I've sort of sold for a loss. And that's Fiat Chrysler, actually. So, funnily enough, that was an investment that I cloned from Monish Prabhai. So,
right, I was going to say, I've seen Ferrari and Fiat Chrysler on people's 13 apps before. Yeah.
Mm-hmm. Yeah, sure. So, I mean, maybe to do a bit of the backstory. So, it's interesting because Fiat Chrysler was probably one of Monish Prabhai's best investments ever, actually. And I recently did a Monish Prabhai best investments, and I included Fiat Chrysler in that. So, Prabhai invested in Fiat Chrysler in about 2012, I think it was. At the time, they were trading about $4 a share. And this was sort of, still a few years out of the financial crisis. So auto companies were still kind of beaten down. General Motors had gone bankrupt a few years earlier. So there was still a reasonable amount of fear kind of in that industry. And the CEO at the time, Sergio Marchionne, said that, he was confident that Fiat Chrysler in 2018, 2019 could be earning $4 a share. So he was sort of looking forward, 5 to 7 years and saying, we think we can earn, that amount annually. And Monish Prabhai looked at it, believed him, could see the path to get to that point, and bought in, and they did get to that point. And they did other things as well, which were quite beneficial for shareholders. They spun off Ferrari, which initially in 2012 was part of Fiat Chrysler. That got spun off probably about at the equivalent of $4 per share. So you basically got your money back just on that spin-off. They also did a whole bunch of dividends through that time, just regular dividends. They did special dividends. And then I guess here I am, and probably about a year ago, finding Fiat Chrysler and kind of discovering this this investment. And after this, really good earnings growth had come out. Sergio Marchionne, who's actually since passed away, Sergio, sort of a year before he retired, came out with their next sort of 5 to 7 years of business growth, and was saying, by 2023, I think it was, we think we can be earning more like $8 a share. And at the time, they were trading at something like 12. So here I am sort of thinking, if they can get to that point, they're basically at a PE of 1.5 on 2023 earnings. Companies don't trade at a 1.5 PE if they've grown over a long period of time.
So far.
So effectively I made the investment. And then I think even after what I'll talk about in a sec, if I was presented with all those same facts today, I would probably still make the investment again. But essentially what happened is, we had COVID-19, and Fiat Chrysler and auto businesses in general have a lot of what's called, operational leverage. So the Fiat Chrysler business has very high revenues, so maybe $100 billion a year in revenue. But from that, they might only make $3 or $4 billion in earnings each year. So they keep a very small percentage of that. And what happens is anytime that you lose some efficiency in your factories, or you have to close down factories, like what happened in February, March, April, you can, even if your revenue drops just a little bit, if that 100 billion drops to 90 billion, for example, your 3 billion in earnings can go very negative very fast. So they went from earning, say, $3 billion a year to losing, I think it was about $5 billion in a quarter earlier this year. And I guess I just wasn't comfortable that they'd bounce back from that. And I could see a path where they were losing, 10, 15, 20 billion over the next couple of years, because there was still a lot of uncertainty at that time about what was going to happen. So I chose to sell about 70% of my holding. And since then, the share price has actually come back quite a lot. And I've actually recouped it. I'm actually in the green on the remaining shares and have recouped some of that loss. So that's quite a nice thing that I sort of held on to a little bit of it there. But yeah, that's probably my worst investment to date. But it's a cool game where you can put money to work, make a mistake, and still get a fair chunk of it back.
Yeah, that doesn't seem like a big loss at all. You did really well. And in terms of businesses with low margins like that, I find, you can get burnt when something goes wrong. So I guess you learned that lesson, but did you feel like you've taken something away that you would like not do again? Or like you said, you would take that bet again if you had the opportunity. Did you learn anything though about analyzing a company from that mistake?
Yeah, certainly I didn't have enough respect for operational leverage before that happened. But I think there was still a good chance, and it may still even work out after I've sold this. I'm sort of talking about it like it's the game over, but it may still work very well. We've still got 3 years to go in this sort of business plan. So I definitely got a lot more respect for operational leverage. But I mean, investing is a game of probabilities, and you're in a business like Fiat Chrysler where even if those things did go wrong, it probably would still look cheap, even if they did have a couple of bad quarters like they did. So there was a good margin of safety baked in, and in my opinion at least, and obviously people have varying opinions on this, but in my opinion at least, the sort of margin of safety built into that investment more than compensated for the operational leverage and the low margins and so on. So that's sort of how I think about it.
Yeah, that's great. Margin of safety is so important. Fully on board with that theory too. Cool. Very logical way to analyze the company. I think that's really important for everyone to hear. When you're talking operational leverage, if someone was to look for that in the profit and loss or the balance sheet, where would they find? Where are you looking for this number?
Yeah, I guess quantitatively, so if you're purely looking at numbers, probably low margins is a good place to start. And then I would say thinking about the actual business itself and what they physically do. So Fiat Chrysler bends metal and sells it essentially, right? So they have a lot of fixed costs. So they have to run physical factories. They have to employ staff, and they have to do this all very, very efficiently. So, if you're in a factory type system, if you have something fall over, the whole, production line, the factory can go downhill very fast, and all of a sudden you're spending a whole bunch of money and not getting much for return for it. So those are kind of characteristics I'd look out for.
Yep.
On the other end of the spectrum, you've got maybe something like the Facebooks of the world, where if I go online and I want to advertise for my business, Facebook gets some revenue from that, and it doesn't cost them a cent, for me I'm not physically receiving anything from Facebook. They're not printing newspapers with my ad in it. They're putting that out to the world digitally. So that's a business that has very little operational leverage. And even when advertisers pulled back a lot in March, Facebook still made a whole bunch of money. So, that's kind of each end of the spectrum.
Yeah. Okay, cool. That buys into a point that I've been focusing a lot on my channel lately, which is gross margins. So not particularly net, but gross. I think businesses with high gross margins just have that cushion for the bad times. I think a little. That's my theory on that at the moment. So cool. All right, that's a very, very interesting insight. Fiat Chrysler. Car companies are very popular at the moment, especially the EV world. So it's interesting.
Fiat Chrysler's not.
No, it's cool that it's a boring old car company. I think it's great. I love boring companies. Cool. All right. next thing, how old are you, and how many years have you had money invested in the stock market? Like, how long have you been, doing this for?
Yeah, sure. I'm turning, what's the date today? I'm turning 26 next week. So
Oh, big happy birthday! That's
thank
fantastic.
you. Thank you very much. So yeah, I've been investing about 4 years. So yeah, like sort of came out of university about 4 years ago. Like I say, started saving up a bit of money and sort of discovering this whole world then. So not all that long, frankly. And I feel like it's been a crash course over those few years of all these things going into my head. So it's been great. And I'm over the moon that I got started early. Have a reasonably long runway, hopefully to grow some money over time. I think it's a massive advantage the earlier you can start.
Yeah,
Mathematically, that is very true. So assuming that you
it
can
is.
stick to it over a long period of time.
You've got 6 years on me, and the extra 6 years of compounding that you'll get will crush me. So,
Hopefully.
so awesome. Okay, cool. Okay, so something I'm building at the moment is what I call an investing checklist. Do you have an investing checklist? And if you do, what would you think are the three most important things that like really have to be on that list? Like, I call them like non-negotiables. I mean, if a company
Mhm.
like doesn't pass these three things, I won't even. I will literally just throw the company away and move on to something else.
Yep. I don't have sort of a formal checklist, although I feel as though I probably should. A lot of the people that I follow do have one.
Mm.
But I do have sort of guidelines, I suppose. So a lot of my very early investment learning was from Phil Town. So going through his sort of what he calls his 4M analysis, sort of meaning, which basically understanding the business. Moat, does it have some sort of competitive advantage, management, and then margin of safety. So that's sort of the general process that I follow. So in terms of non-negotiables, those are sort of the hurdles that I go through, basically in that order. So the first one is if I don't understand the business, it's out. So,
Okay,
you know,
that's good. Yep.
yeah. So I mean, what I'm trying to do fundamentally, like I say, is try to buy something for less than it's worth, trying to get more value than what I pay for. So if I don't understand the business and I can't, I'm therefore not going to be able to project the future cash flows of that company, put a value on it, and be comfortable in the investment. So that's sort of probably the biggest one that eliminates most businesses, is just not being comfortable that I understand it, or at least not being comfortable that I understand it maybe a bit more than the average investor. So that's the first thing. And then probably the biggest other thing is just, again, being able to actually value it. I think it's easy to run numbers through a formula or through a spreadsheet and, fall into this false sense of security around numbers that you've generated. But being really able to have a good handle and be confident on those future cash flows, which inform a valuation, is the other thing. So if a company is not profitable, or with the odd exception, if it doesn't have predictable earnings over time, then that's sort of out the window for me as well.
Cool. Yeah. Okay. They're really great points in terms of not understanding particular industries or particular companies. Give us some examples of just like you just literally just can't even look at because you're just like, wow, that is just too hard to even get my head around.
Yeah, so I mean, but I just did a video. I think I released it this morning actually on 13F updates. So I love following the quarterly filings of what big investors are invested in. And Buffett just made 3 investments in 3 very large pharmaceutical companies, and I know nothing about pharmaceutical companies. So I'm not even going to read the annual report of those businesses, as I already know it's not going to happen. So that's an example. Moustache Probri, again, he has had a holding in Micron for a long period of time. I have tried to do some digging on that, and I just can't get there with Micron. But show me a McDonald's annual report, and I'm there all day. So
Yeah. Okay. Awesome. Okay. My weak spots are anything to do with electric cars. Anything down that path, I just can't even. I can't even open it up. Like I just don't get it. And mining, I find I can't get my head around mining and commodity
mhm.
businesses very well. I find that just way outside my comfort zone.
Yeah. Yeah, and there's a lot of those in Australia. You're probably turning away, which would take out a good chunk of the ASX.
It takes out a big chunk of the ASX. It does. Yeah.
Yeah.
Interesting that you bring that point up. So I was going to finish with this, but I'll ask you now. because you're in New Zealand, you have quite an advantage over for the New Zealand stock market. I've never even literally, I don't even know any companies in the New Zealand stock exchange.
Mhm.
I know, like, I even find Australian companies difficult to do an analysis on generally. I find it very easy to do an American one. But you, I should be playing a bigger, I should be focusing more attention, I think, on the market that I actually know and the culture that I understand. Um, do you have a, maybe not a bias, but do you think that the New Zealand market is a really good hunting ground and something that you spend quite a lot of time doing? And do you think it is an interesting place because you have quite an advantage over most investors?
Yeah, I think it's interesting because, like you say, there's going to be companies in there that I understand quite well, and understand the local culture and so on. The downside in New Zealand specifically, and probably to a lesser extent in Australia, but certainly still versus maybe the big markets like the US, is it's tiny. Uh, the US has an S&P 500 index. We have a New Zealand 50 index. Where there's just less companies in general, and they're smaller. So I think our biggest market cap company is probably A2 Milk, which is like 10 billion New Zealand dollars, so maybe 6 or 7 billion US dollars.
Right.
That's minuscule. Like our whole stock market, I think, is about, last time I looked, probably 150 billion New Zealand dollars again. So maybe call it 100 billion US dollars, which is like what, 5% of Apple. So
Yeah, that's right. There's 50 companies bigger than that in America. So yeah.
yeah, so it's very, very small. That said, it means those companies are less closely followed. So like I was talking about earlier, there's potentially more opportunities for mispricing. But the other thing is, there's less of them to look at, so naturally you find less opportunities. And we don't have a lot of these sort of modern Buffett, compounder type businesses. There's just not a lot that have kind of come out of New Zealand.
Is
We
it
have a very
because the growth is limited, right? Because they're bound by such a small market size. Like, there would be companies that are exporting into China, I assume, which
Yep.
open it up. But
Yeah, there certainly are, and A2 is a pretty good example of that. But New Zealand also still has a very agricultural heavy focus, and I work in the agricultural industry and understand that all very, very well. The downside to having a circle of competence in agriculture is, again, probably with the exception of A2, you're largely selling a commodity. So in order to be the winner as a commodity seller, you basically just have to be the low cost producer, assuming that you can't get some sort of premium, which a lot of New Zealand companies are trying to do because we're grass fed and free range and all that sort of stuff. But at the end of the day, when a consumer is looking at milk on a shelf, it's hard to charge 5 times the price or something, simply because it came from New Zealand, when there's not, in all reality, there's not all that much difference between the products. So we don't have the big sort of brand heavy names like the US stock market does. So it makes it tricky to find those really high return on invested capital, long-term sort of growth.
okay, so there's potential for opportunities for asset plays, I guess, like something getting seriously undervalued and returning back to a fair value. But yeah, okay, I get what you're saying. That makes sense. Cool. Thanks for that. And all right, we'll finish off with the last question. Influential books. If anyone's watched any of Tom's YouTube videos, you'll notice that he has a bookshelf behind him with lots of different books on it. And I just would love to know your favorite couple of books, and probably the most influential ones over your strategy, your investing style.
Yep. Yeah, so probably the most influential ones will be pretty much all of Phil Town's books. So he's got 4, I think, at this point. No, he's got 3, I think. So he's got Rule 1, which I started with, then Payback Time, then Invested, which he wrote with his daughter, Danielle. If you just want to skip straight to Invested, that would be perfectly fine. That basically recaps the previous 2 books and then adds some new stuff in there as well. So
Cool.
Definitely recommend that. He's probably the first guy that took the Buffett strategy and laid it out in easy to follow kind of practical steps, which I found very, very useful. Because the first investing book I actually read, which I'll recommend now, and you've probably heard from every value investor ever, is The Intelligent Investor by Ben Graham. It's a great book, and it's a lot of the
that's a hard book to read. I wouldn't give that to anybody. Really?
It's a very hard book to read. If you just want the good bits, just read chapter 9 and chapter 20, which are Margin of Safety and Mr. Market. The sort of the two core chapters, I guess, that are really important. But that was the first investing book I read after so I've read my first book ever on money, which was Rich Dad Poor Dad. Then I read
Oh,
first
yeah.
book on investing, which was The Intelligent Investor, and that was just way too much.
It's a big
so
book.
so
Yeah. Wow. Okay.
yeah. So start with Phil Town. After that, I really like Peter Lynch, One Up on Wall Street. He's a bit more of a growthier style investor, but it's really good.
That's my favorite book.
Um,
That's the one for me. Yeah.
awesome. And then probably something maybe a little bit different than that people might not have read would be something like 100 Baggers by Christopher Mayer, I think is the author's name.
Yeah.
So
Yep.
that's basically a study of around, I think, 300 companies over a 50-year period that went up 100x, and he excluded, the mining companies that went up 100x and then went down and all that stuff. So, genuine 100 baggers, really high quality businesses, basically went through and did a study of what are some of the common characteristics of those stocks. So that's a really interesting one that I've just read this year as well.
Yeah, I'm actually going to do a review of that book at some point. I think, yeah, I got a lot of information out of that one as well. I don't even know, but I read it quite a while ago. I really need to probably read it again. So there's some great. I've never even looked at Field Town's stuff before. That sounds really interesting. I got something out of that for myself. That's obviously, they're the first books on my list now. So thanks a lot. Look, Tom, that's it. Thanks for your time. We appreciate it a lot. Please, everybody, if you get a chance, go over and check out his stuff. I actually think, even though Tom's significantly younger than me, I think you know your stuff even better than I do. And the 4 years that you've been investing for, man, you've really, that's a long way you have come in just 4 years. So that's good inspiration for a lot of people out there just starting, to where the knowledge that you can acquire over time. So thanks a lot for joining us today. Please support his Movember cause as well. I will probably try to get a link from you to put in either my description to go to your channel to donate money as well. We'll work something out.
Yeah. No, I appreciate you having me on. I enjoyed it.
No, thanks a lot, mate. All right, cheers.